Canada's expanding exports are quietly reshaping North American trade as long-standing American advantages begin to slip away. What does this shift mean for the everyday lives of American families, especially those who've spent decades building their livelihoods in trade and manufacturing? Canada has officially launched its first major shipment of liquefied natural gas, LNG, from the newly operational LNG Canada facility in Kitimat, British Columbia. With an initial capacity of 5.6 million tons per year, this project provides a direct shipping route to Pacific markets, significantly cutting travel time compared to U.S. Gulf Coast ports. Major international companies such as Shell, Mitsubishi, and Petronas have signed long-term agreements, citing Canada's logistics, advantages, and competitive pricing, offering LNG at $0.71 per MMBTU, cheaper than U.S. benchmark Henry Hub prices, according to Bloomberg's June 2024 report. This new reality spells trouble for thousands of workers in the U.S. natural gas sector, especially in states like Texas and Louisiana, where export orders are shrinking. With contracts shifting north, many American workers face a tangible risk of layoffs or reduced shifts as Canada becomes the supplier of choice. Beyond jobs, U.S. households may see higher domestic energy prices as more American gas stays home, driving up costs and putting pressure on monthly living expenses for families and retirees. Industry analysts from S&P Global expect Canada's LNG output to more than double by 2027, further expanding its footprint in Asian markets. If current trends continue, the U.S. could lose up to 30% of its LNG export share to Canada within 5 years, leading to deeper job cuts and potentially fueling regional economic slowdowns in key energy states. Some experts even predict that U.S. gas infrastructure could face underinvestment, affecting long-term reliability and pushing local governments to seek new economic alternatives for affected regions. Canada's reputation for clean, transparent, and sustainable exports is drawing new demand in global markets, particularly for FSC-certified lumber, organic wheat, cheese, and hydropower equipment. Vancouver has overtaken many U.S. ports as the primary gateway to Tokyo and Seoul, with American ports reporting reduced activity. According to the U.S. Department of Agriculture, Canadian wheat exports to Asia rose 18% in 2023, while U.S. shipments dropped 11% in the same period. This market migration has concrete effects on American workers, notably those in agricultural processing in Pennsylvania and Michigan, who are losing export contracts and being forced onto less profitable day shifts or even let go. Supply chain disruptions ripple across entire communities. Layoffs mean loss of employer-sponsored health insurance, reduced savings, and growing economic stress for families who once relied on export-driven industries. Trade experts at the Peterson Institute predict Canadian agricultural exports to Asia will continue rising, possibly surpassing U.S. levels in key categories within 2 years. Unless American producers can match Canada's standards or cut costs, job losses and plant closures could accelerate, especially in the Midwest and Northeast. Policymakers warn that unless bold steps are taken to modernize American agriculture and invest in export infrastructure, the country risks losing ground in sectors that once formed the backbone of rural prosperity. Global confidence in Made in USA is starting to slip as multinational buyers turn to Canadian suppliers for greater policy stability and reliable delivery. Recent high-profile contracts in LNG, uranium, nickel, and lithium have shifted to Canadian firms, a move largely credited to Canada's consistent regulatory environment and absence of sudden tariffs, as reported by the Wall Street Journal in May 2024. For many, the Canadian advantage is simple. Contracts are honored and shipments arrive on time. Communities in Ohio and Missouri, once thriving on export manufacturing, now face plant slowdowns and lost deals. Small towns, built around logistics and transport, are seeing warehouses empty and truck fleets idled. Many business owners report that domestic-only delivery brings lower margins and fewer opportunities, making it harder to sustain jobs or reinvest in local growth. Economists at Moody's Analytics warn that without policy reforms or renewed trade competitiveness, American export hubs could see a persistent decline. Over the next 5 years, entire regions may shift from industrial growth to stagnation, impacting both blue-collar and middle-class families. The longer-term challenge will be revitalizing innovation and rebuilding trust with global partners, which could determine America's manufacturing future for decades. For many Americans, and especially in the Midwest, these economic shifts mean more than just lost jobs. They signal a profound loss of faith in the future. With income and employment vanishing, older families are being forced to tighten budgets, cancel plans for college tuition, or forego essential health insurance. The psychological toll is real, with many expressing anxiety about their children's prospects and the survival of their communities. When a local plant closes, schools face funding shortfalls and may be forced to shut their doors, while homes sit vacant and youth migrate to more prosperous cities. These two-speed communities foster a growing sense of fear and insecurity. Surveys from the Pew Research Center, 2024, reveal a sharp drop in national pride linked to manufacturing and export declines, raising concerns about the social fabric and the resilience of the American dream. Sociologists from Harvard University suggest that unless new job opportunities emerge or robust social safety nets are enacted, American towns at the center of these changes may face a lasting divide. Rebuilding economic confidence and restoring faith in Made in USA will require collective action from policymakers, business leaders, and communities alike. Without concerted efforts, the risk is that generational hardship and disillusionment become the new norm in many parts of the country. Forecasts show ongoing challenges as Canada rises in export power, and American communities feel the impact. Only by uniting and taking decisive action can Americans protect their livelihoods and revive the spirit of national industry in the face of these global shifts. In 2025, Trump's shifts from tariff threats to diplomatic praise are colliding with China's rare earth squeeze, hitting American industries hard. Could Trump's sudden diplomatic pivot be the real reason behind widespread factory shutdowns and soaring inflation in the U.S.? In early 2025, President Trump vowed to make China kneel under new 145% reciprocal tariffs, aiming to bring back lost jobs and shrink a $1.2 trillion trade deficit. By June, he praised a call with Xi Jinping as very good, despite no formal agreement, sparking criticism that it's false victory spin. The abrupt tone shift rattles investors, businesses, and workers. A Goldman Sachs survey revealed 77% of small businesses cite policy uncertainty as their top concern. That uncertainty leads 36% to report direct harm and 38% to expected. Predictable policy is the foundation of planning. Its absence weakens strategic investment, erodes economic confidence, and may dampen GDP growth as firms pause hiring and expansion. In April, China banned exports of key rare earth elements and magnets, controlling 70% of global mining and over 90% of refining. Permits for shipments to the U.S. have fallen sharply as Beijing intensifies security licensing. This chokehold halts electric vehicle, aerospace, and semiconductor production. Factory delays ripple through supply chains, raising costs by up to 15% in auto assembly and electronics. Businesses are stockpiling components. Half of Fed districts cite supply chain disruptions in surveys, With rising manufacturing costs, consumers face higher prices and less stable product availability, while strategic dependencies undermine U.S. tech sovereignty. Ford and major defense firms halted production due to lack of rare earth magnets, essential for motors, brakes, missiles, and radars. Analysts warn Pentagon readiness could be compromised not by combat, but by material shortage. The Chicago Ford plant alone paused for weeks, impacting workers and vendors. Bloomberg reports a temporary shutter of one factory, halting production lines. Layoffs ripple through supplier networks. Defense delays threaten jobs for engineers and technicians. Public trust in manufacturing and military readiness weakens, feeding anxiety over the government's ability to secure critical infrastructure and national defense. Tariffs and rare earth disruption pushed U.S. shipping and input costs up around 15 to 20%, squeezing small retailers, toy, electronics, and hardware stores in Iowa and Ohio report rising inventory costs, canceled orders, and closures. Small business owners, representing 1/3 of U.S. imports, report duties as high as 161%, shrinking margins. Many are drawing on personal savings or cutting staff to stay afloat. Consumers face fewer local shopping options, higher prices, and delayed orders. As small business closures rise, local employment dips, impacting community economies and increasing reliance on social safety nets. Investor confidence in U.S. government bonds is slipping as debt hits new highs and fiscal challenges mount. What changes might ordinary Americans face as financial risks grow? On June 12, 2025, the U.S. Treasury is set to issue $22 billion in 30-year bonds. But global investor faith is weakening. The 30-year Treasury yield recently surged to 5.15%, the highest since 2007. Between November and February, foreign central banks sold a net $19.6 billion in long-term treasuries and shifted into short-term T-bills, signaling rising caution. By January 2025, foreign holdings in U.S. treasuries stood at $8.526 trillion, with Japan holding $1.079 trillion and China $760.8 billion, according to Bloomberg. As trust in U.S. bonds declines, borrowing costs rise. Americans will face higher interest rates on mortgages, car loans, and credit cards, squeezing household budgets and making it harder for families to buy homes or cars. Higher rates also slow spending and threaten job growth, putting pressure on both businesses and workers nationwide. Moody's has cut its outlook on U.S. government credit due to surging debt, now over $36.2 trillion as of December 2024. The annual interest cost is expected to top $1.13 trillion by 2026, overtaking national defense spending. Moody's warns, the U.S. faces rising fiscal and political risks. If deficits continue to grow, if interest payments overtake defense, funding for programs like Social Security, Medicare, and public education may be cut. This could reduce healthcare access, shrink safety nets, and make it harder for families to get support or send children to college. Such cuts would especially strain the middle class, increasing financial stress and making the future more uncertain for millions. While new retaliatory tax proposals, such as Section 8.99, have made headlines, details remain unconfirmed and are under debate in Washington. Financial experts warn any sharp tax hike on foreign investors could trigger capital flight from the U.S. bond market, right as the country faces massive refinancing needs. If foreign capital pulls out, the U.S. must pay more to borrow. This means even higher interest rates for families and businesses. Rising borrowing costs could push up prices for goods and services, while making loans harder to obtain. In turn, job cuts and spending slowdowns may ripple through both public and private sectors. Putting even more pressure on American households, the Consumer Price Index rose 0.3% in May, lifting annual inflation to 3.6%. Trump's proposed $250 billion in tariffs on Chinese goods may drive inflation higher. Each 1% increase in tariffs could push core inflation up by 0.4 percentage points, according to Bloomberg Economics. Stubborn inflation and slow growth point to a possible stagflation scenario, where rising prices erode investment returns and investor confidence falters. Stagflation means everyday essentials, like food, fuel, and services, cost more. But wages don't keep up. Millions could see their paychecks stretched thinner, making it tougher to pay bills and cover basic needs. The risk of layoffs and job insecurity would rise, leaving many families facing harder choices and a tougher financial future.